Good afternoon. Thank you all so much for joining us today. You know, back in January, when we did our first live web stream, we had no idea that that would be the only venue that we had to offer you this time. As a matter of fact, I don't think back in January we even talked about the coronavirus. And yet just 3 months later, the entire economy was shut down. We're going to spend a lot of time today talking about the financial impact on both our economy and the markets. But I'd like to begin by talking a little bit about what I refer to as the human impact of coronavirus. In May of this year, I celebrated 35 years in the business. And you know, when you get to that point, you kind of think that you've got it all figured out. Not that you've seen everything and done everything, but you think you have a good understanding of the way the world works. But this taught us all that you just never know how uncertain the world really is. And we've had the opportunity over the last couple of weeks to talk to all of you and learn about the missed celebrations, the trips that never happened, the many events that had to be canceled or postponed because of coronavirus. We learned about the tragedies of losing somebody and not being able to be there during their last moments, and that's just unspeakable. And for all of us, I think of this as a loss of time. Time to do the things that we'd rather be doing, spending time with family and traveling. And time is the one thing we don't get back. And yet life has a way of showing us that things just move on. And on March 1st, Adam and his wife, Kara, gave birth to a beautiful baby girl. And although their family had to love her from a distance, it didn't take away from the beauty of a new baby. And on June 4th, Mike and I became grandparents. And I'm not being biased at all, but I'm absolutely sure that he is the most perfect and beautiful baby boy in the world. And so with this, we just hope that we just never again have to experience the fear and isolation of this silent and invisible enemy that still resides amongst us today. And as I've always said in my 35 years in this career, that it's the spirit, resiliency, and ingenuity of our society that is an even greater force to be reckoned with. It is this human spirit that brings us together, unites us as one, and allows us to step up to these challenges. So no matter where you are, I try to remember, take one day at a time, and think about it that this too shall pass. And I'm hoping that this afternoon, over the next 30 to 40 minutes, we can make sense of the financial impact of this human tragedy. So let's get started. 2020 will definitely go down in the record books. This is going to be a year that we talk to our children and our great-grandchildren about, and something that's going to be etched in our memories forever. And it's been a unique year, and what we're going to do is we're going to start and we're going to follow our format that we normally do. So we're going to talk about where we've been, where we are now, and where we may be going. And as usual, to keep with some semblance of normal, we're going to start with our little bit of a quiz on pandemic life, just to kind of get your brains going this afternoon. And so the first one is, who DJs a pandemic-inspired online pirate radio station? Is it high schoolers, college students, parents of young children, or retirees? Well, here's ingenuity. It is actually retirees. And they've got a tagline for the radio station, staying together, keeping apart. So anybody who guessed retirees, that's one for you. And I think the biggest challenge throughout this has been parents with young children. And a 3-year-old asked their parents if if they would possibly be able to tell her a new and interesting fact each night at bedtime. So of course the parents took to the internet to get some new ideas. So which one of these do you think are true? Birds see ultraviolet light as a unique color. Cats can be allergic to people. A blue whale's tongue weighs as much as some elephants. If you picked all three, you're absolutely correct. And so I take my hat off to you parents that are at 24/7 with young children at home. And so last but not least, a company in Germany developed a calculator during the pandemic. And what did it measure? The number of song lyrics rewritten to accompany hand washing, the amount of toilet paper needed during a pandemic, the amount that should be paid to teach for parents to distance learning experiences, the ratio of ingredients for homemade hand sanitizer. Well, it has to be toilet paper, right? A person with stockpile of 10 rolls who uses a typical amount of paper 3 times a day should survive for 53 days. I'm sure we could debate how that would work. So let's get on to the markets and talk about where we've been this year. And although we're only halfway through the year, and it seems as if the only thing that's been going on out there is headlines with regards to coronavirus. But as usual, there's a lot of things in the background. The U.S.-China trade tensions are still ongoing. The U.S.-Iranian conflict. Don't forget about Prince Harry and Meghan Markle leaving the royal family. The impeachment trial. And for those of you in the sports world, the tragic death of Kobe Bryant. Britain exited the European Union. We had the end of sports and concerts and shows. Never before did we think we'd see things like that shut down. A U.S. recession and U.S. civil justice protest. That's an awful lot to take in just halfway through the year. In addition to that, we saw the end of the longest bull market in history. After a decade, on March 11th, the market technically entered a bear market. That means that we dropped a full 20% from top to bottom. What's interesting is that during that same 6 months, we also experienced one of the best quarters in history. The time is what's been so extraordinary. In less than 30 days, the market priced in the level of fear that is usually taken to reach even during severe recessions. And in managing money, and for those of you out there investing, this is the one thing that's been really difficult to get used to, is that information travels exceptionally fast and money moves even faster. And so what we've seen is that bottom red line on the chart that you're looking at right now, we've talked about this quite a bit in the past. The red line on the bottom represents the VIX. The volatility index, or what we often refer to as the fear index. And you can see at the very far right of that chart, the VIX spikes up dramatically. The blue line that's running over the top represents the S&P 500. They become a mirror image of each other. As the VIX shoots up higher, what do investors do when they get nervous? They sell stocks. The S&P collapsed. The VIX turns around, fear starts to subside, and stocks make their way back up again. We're going to talk a lot this afternoon about what factors contributed to the ability of fear to subside and investors' willingness to get back into this market again. Flattening of the curve. And this is a term that we probably all heard way too much, a term that we don't really want to hear again. That top red line represents the U.S. And we had governments around the world trying to get in front of this virus. And we've taken unprecedented steps, and some more effective than others. But we were successful through closing our schools and our workplaces, restricting public gatherings, a stay-at-home order, never before seen here, public transportation closes, and travel restrictions that still exist today. What's important about that top line, though, is if you see the line comes down, we get in front of the curve, but you don't need me to tell you, this thing is breaking out again. We're seeing the number of viruses escalate, and that line is moving back up again. The best place to look at the impact on the economy is GDP. And we've talked for the last several years about our economy having the ability to break above a 2% growth. We've been stuck in 2%. This thing hits, You see that steep drop, that last bar, GDP down by 5%. But that's not really telling the story here. That's first quarter. First quarter, this thing was just starting. Estimates for second quarter GDP are for GDP to decline by almost 40%. And if that number is shocking, that's an improvement from where a lot of economists were just a couple of weeks ago. We are starting to see some signs of hope. Jobless claims. We've had 2 back-to-back employment numbers showing better than expected numbers of people going back to work. The financial markets have behaved unbelievably well, giving people confidence and allowing their net worth to improve. Mortgage applications. We wrote last week about mortgage rates hitting historic lows, and people are out there and they're buying homes. We're seeing real estate in certain pockets of the country literally on fire. Consumers are feeling okay. We're seeing restaurants and airline participation go up, public transportation, and electricity demand, which is a way of really measuring raw economic activity. But on the other side, we know it, the cases are rising again. Investors are still hanging on to what we call the lockdown index. Markets are higher, but they're buying those things that represent a stay-at-home economy. So that's not a real good sign. Same-store sales are not improving. The oil rigs are not coming back online, and we're not seeing it in the raw level of steel production and manufacturing. So although we're seeing some improvements, it's certainly not behind us yet. This graph really needs some context. So the headline is great. U.S. unemployment has trended lower. Those back 3 bar charts are the last 3 months of unemployment. Let me get into a little bit more detail. The blue line represents U3, which is unemployment for those people who are not working and actively seeking work. The red line, the higher line, represents U6, which is a much broader representation or definition of unemployment. U6 includes those people who are underemployed and those that are discouraged workers. So even though we can say in a headline that unemployment is trending lower, U6 is still over 20%. That's not a healthy economy. That still needs to come down in a very big way for things to really improve. We're seeing improvement in the ISM, the manufacturing index. And manufacturing represents 11% of our economy. It represents over 18 industries, everything from beverages to chemicals. And that top black line on the chart, you can see the dip in the ISM, but a nice steep improvement as soon as we started to relax some of the restrictions in the economy. We also have seen new orders rise, which is a real positive to the economy. Consumer spending has improved, yet personal income has declined. This chart really says a lot about where we're going from here. Consumer spending is the dark black line. You see it trending down as soon as we shut down the economy, and then a sharp spike to the upside. Look at what happened to consumer income or personal income. Personal income rose when the economy shut down, and now it's begun to decline. So where do we go from here? And a lot of this has to do with the fact that some of that spending came from temporary money available to the economy through the stimulus and the additional unemployment benefits. The problem is that the one-time payments have already been dispersed and the enhanced unemployment benefits are set to expire the end of the month. Even if hiring continues and wages keep rising, which is increasingly doubtful as many states and cities roll back their reopening plans as the virus spreads, that means disposable personal income will abruptly fall 3 to 4% below where it was in February. We're losing our small businesses. Small businesses are the backbone of hiring and jobs in this economy. And this graph shows us it cuts across all demographics. We're losing businesses in every sector. We've lost now 20% of our small businesses, or over 3 million small businesses that have closed their doors so far. That's going to be a hard thing to replace as we move forward. I'm going to call this another double-edged sword. Personal savings rate has increased. We've seen savings increase to the highest rate since the 1960s. Is this an indication that people are finally deciding that they need to put away money for a rainy day? Or is it simply a factor of the fact that people have not been able to spend? And so we'll have to see what that has an impact on later on. The Federal Reserve reminded us during this crisis that 49% of Americans did not have enough savings to pay a $400 emergency expense. Crises like this expose the weakness in our economy, and we've got a big hole in our economy right now. So, where are we now? Well, we're finding ways to keep and fill our time. And I'm sure many of you have had to do things to kind of keep yourself busy that we're not accustomed to doing. And so the Getty Museum commissioned people to go out there and replicate their favorite paintings with common household products. And so this is a laundry day version of the Diebold horse, painting all the way back from the 1600s. And of course, you know, somebody had to use toilet paper in this. This is a toilet paper replica of also another 1600 painting called Lady with Gloves. And last but not least, this creative artist recreated a Rembrandt and was quick to make sure that people were aware that the brush that is on his head is used to scrub vegetables. So I figured it would be important that you understood where that brush was before. So we'll move on back to the markets now. Markets have been exceptionally volatile. And if you follow our commentary, our weekly updates, I wrote recently about the fact that we have had 38 days this year so far of more than 2% volatility in either direction. And that's putting us on pace for the most volatile year since 1933. And you can see here the black line in this bar chart represents Q1 results. So as of the end of the first quarter, the S&P 500 was down almost 20%. By the end of the first half, which is the light gray line, by the end of the first half, the S&P 500 was down only 3%. Look at the NASDAQ. NASDAQ was down nearly 14% in the first quarter, finished the first half up almost 13%. The other takeaway from this graph, not only the NASDAQ, two other sectors that are positive, gold and bonds. So it gives you some idea of what's been working out there. Stock valuations, we reference this just about every time we get together. And it is a way of looking at whether stocks are expensive or inexpensive relative to some historic norms. And this is telling us that the Shiller PE is at 29. The historic average is only 16.7, which would tell you certainly that the market as a whole is expensive. But what I want you to walk away with today, and something very important, the way we have the ability to manage money, that we're selecting individual stocks for you. Individual stocks don't necessarily have the same multiple or the same ratio as the market as a whole, which gives us the ability as your money manager to be very selective about how what multiple we're willing to own, and at what multiple are we willing to buy stocks. So we're not buying the market as a whole. The second piece is another part that really allows us to get to the heart of where we want to be as money managers. These are the different sectors. It's a great saying, all sectors are not created equally. Technology is up 14% this year. At the same time, energy is down almost 40%. We have the ability to dissect this economy and make decisions for you on a daily basis as to what sectors do we want to own. And here's a simple way of putting that. Given what you know out there, would you rather own Amazon or Macy's? Pretty easy decision. Would you rather be invested in the food companies or the airlines? Well, maybe some of you want to speculate the airlines might look attractive here. But that's what sectors give us, the ability to break the economy down into pieces and decide which parts of the economy do we want to own. And one thing that's been most interesting about this particular crisis, there are sectors in the economy that are working better than they were before this whole thing started. So we know where we need to focus. Earnings. We just are starting earnings season right now. First quarter earnings down 15%. But remember, like GDP, things were just starting to unravel in the first quarter. It is estimated that second quarter earnings will be down to the tune of 42%. That's going to be painful. Why then are stocks sitting where they are today? It's because investors are looking all the way out. Look at Q1 estimate 2021, back into positive earnings territory. Investors right now are telling us that they're willing to look past 2020, write it off entirely, and look forward into 2021, where they assume that things will start to get better again. But this is a lot of assumptions. And I recently read an article, and the author was talking about what he referred to as the hope factor. And what amount of the valuation today is based on hope? And his opinion is there's quite a bit. The American Association of Individual Investors reminds us this: stock prices are established based on expectations for the future earnings power of the firm. Earnings estimates embodies investors' opinions of factors such as sales growth, product demand, competitive industry environment, profit margins, and cost controls. Stock prices adjust to these or change as they're proven wrong. We have a long way to go to understand if stock prices today truly reflect the economy that we will have at some point in the future. Here's one reason that fear dissipated immediately in the end of March. On March 23rd, the Federal Reserve stepped in. And the Federal Reserve not only said, I'm going to bring rates down to zero, I'm going to make money very inexpensive and available to those who need it. He went one step further. And he said, I will lend, I will buy corporate bonds. And why is this important? First, let's understand that when the Federal Reserve cuts rates, it has historically stimulated the economy. If people can borrow cheaply, they're willing to go out and borrow to invest or borrow to spend. But this crisis was different. Business stopped immediately. Companies who normally have access to capital, the windows were just shut. When the Federal Reserve said, I will buy corporate bonds, he essentially extended a hand. And Wall Street understood that by him being able to lend directly to corporations by buying their bonds, meaning that when they want to raise debt, he is there as a buyer, he basically put a backstop against the fear that we were going to have a domino effect bankruptcy that would be unlike anything we've ever seen before. Stock investors knew at that moment. As soon as the Federal Reserve stepped in and said, we will use all tools necessary, we will take unprecedented moves, the stock investors knew this was the time to get back into markets. It does not mean that all companies will survive this crisis, but it did mean that the mass chaos that was upon us back in March was resolved pretty quickly, and investors got back into the markets. We still don't understand if we're there enough. Governments stepped in at the same time, and this is governments and central banks across the world. The next to the last bar chart on this graph is showing you what governments around the world expected to spend. The last bar chart is how much governments have committed to this already. The problem we have is we still don't know if it's enough or not. The other thing about this is that it is easy for governments to step in. It is very difficult for them to exit. My goodness, last year we were talking about the Fed raising interest rates. This is from post-crisis 2008, 2009, and they were still trying to exit that. Now we're back into this again. The burden of the downturn has not fallen equally on all Americans. Instead, those least able to withstand the downturn have been affected the most. Low-income households have experienced by far the sharpest drop in employment, while job losses of African Americans, Hispanics, and women have been greater than that of other groups. If not contained and reversed, the downturn could even widen the gaps in economic well-being that the long-lasting expansion made some progress in closing. This virus itself has been very discriminating. And we all know the statistics that the older age category that you're in, the number of deaths due to this virus has increased. But this virus has been even more discriminating. At every bracket of ages, the Black and Hispanic Latino households have been affected much more greatly than other households in this country. Treasury yields have been reflecting all of this turmoil. The middle part of the graph is last year. That's 2019 when the Fed was raising rates. We were starting to think that we were moving a little bit closer to normal. Rates had risen a bit, and then you can see immediately that those rates collapse. Toward the end, you can see that we started to see rates rise in this country. As soon as we started to see the numbers go down, we got in front of the curve. And then as the virus has spiked up again, interest rates have declined once again. This graph tells us a lot about what's going on. Number one, the top graph represents the yield curve in June of 2019. We talked about this last year. That dip in the middle represents long-term rates declining below short-term rates. So you can see short-term rates were at 218, three-year rates were at 171. That forecasts very often a recession. And by the way, in February of 2020, our economy technically entered into a recession. On the bottom line is the yield curve of 2020. That's a normal yield curve. It is upward sloping. So that's good news. But I think what's really telling here is just how low yields are. Look at the contrast. 1 year ago, we could have invested money for you in a 1-month treasury bill and earned you 218. In today's world, a 1-month treasury will get you 0.13. We talk very often about how these types of crises and the actions by the Federal Reserve to help the economy punish savers. We get calls all the time from you guys. People have saved some extra money and they're looking for a place to park some money safely where you could possibly get a good rate of return. Unfortunately, this environment has taken that privilege away. Just think about it. $100,000 at 2.18, $2,100 a year. Not that bad. Not great, but not that bad. How about $130 of earnings on your $100,000 of hard-earned capital? That doesn't go very far. If rates remain this low, it is going to be a very long road for savers in this country to be able to earn the yields that they're entitled to. And so we've seen this, every year for the last decade, if not longer, the end of the bull market in bonds. And so once again, another call, and this is Jeremy Siegel, who's very well respected, who said, well, the end of the bull market is here. Well, unless we head toward Europe and we actually go into negative interest rates, rates don't have that much to fall. So certainly it would be a reasonable expectation to see interest rates in this country rise. And of course, they'll have implications that we'll have to deal with. if in fact we start to see interest rates go up. So where do we go from here? Where are we heading at this time? You know, and this really says, I think, a conversation we've had in my house. Well, how many seasons is this? Have you sat there a couple of nights and said, you know, I can't believe it's been 2 weeks. I can't believe it's been 5 weeks. I can't believe it's 2 months that we're doing this. This is the problem in a nutshell. We don't know yet how long we are going to be doing this. For as long as we've been going through this, today we still have more questions than we have answers. Uncertainty. When will we find a vaccine, a therapy, or a cure? I can tell you this, it'll go a long way for consumer confidence. Every day we get news in the markets that there's positive developments on either a vaccine or a therapy. Stocks trade higher. It'll go a long way to get things back to normal if we get any one of these. Will there be a second wave? Are we in a second wave already? Is this what we're seeing in other parts of the country? Will it come back here to the East Coast? Will it be worse than it was the first time, or can we handle it better? We don't yet know. Have consumer habits changed permanently? We talk about more savings. Will people save and prepare for the future a little bit better? That's good news and bad news. If we're saving more, that means we're not spending. That's a smaller economy. That means we don't get back to the levels that we were in 2019. Will people get back on airplanes again? Will they travel? Will they go to hotels? We don't know the answer to that either. Have industries been altered for the future? We've watched movies now go directly from the studio to online because the movie theaters aren't open. Will they reopen, or will we just see that whole industry disappear? These are the questions that we don't have the answers to. What about commercial real estate? Would you want to own a 50-story building in Manhattan right now? Are the workers going to come back? What will it look like? Will businesses recover quickly or slowly? That's on us. We as consumers. If we're feeling good, we're going to return to our old ways. But if we're not, that's going to be a struggle for businesses to come back online. So what shape will this actual recovery take? Right now it feels like a V. We had a sharp move down, and surprisingly we've had a sharp move right back up. But from everything we've been talking about today, and we all understand, we are not yet through this. Well, maybe we'll have a W, which means that we get another sharp move to the downside and then ultimately get to a recovery. This really hasn't been a U where you get a drop and you stay down for a long time and ultimately recover. From everything that we're seeing right now, a W does make an awful lot of sense, and that we still have some tough times ahead in the markets as we move into the second half. Consumer sentiment is going to really affect the pace of this recovery. Consumer sentiment in June was better than it was a month ago, but we're a far way from where we were 1 year ago. And if we don't come out, and if we don't spend en masse, if we don't go back to our old habits, the economy won't look like it did before this started. And wouldn't it be nice if we only had COVID-19 that we had to worry about? The pandemic is intensifying political frictions, posing downside risks to the markets. The crisis has exacerbated tensions between the U.S. and China, in particular bringing relations to their lowest point in decades. Potential flashpoints include trade commitments, technology, investment restrictions, and policies toward Hong Kong. We've got a lot of other things that we're going to need to be dealing with over the next 6 months. One economist put it this way: it's an important issue that already facing governments and central banks is to how to calibrate the removal of policy. The most pressing aspect of this is how to taper employer subsidy programs without causing a huge spike in unemployment. Policy needs to shift from combating a crisis to supporting the recovery. Making this transition will not be easy. One of the biggest risks in the near term is that governments move too quickly to embrace a new round of austerity. But where does the money come from? We have not even mentioned the election. And that is going to be a major source of volatility for this market going forward. And we're doing a lot of research on the impact, looking at the historic relevance of elections. And this one, I don't think anybody's going to know how to call. Yet this strategist sees it pretty clearly. Either the markets sell off in the short run to register the current likelihood of a victory of Joe Biden, who will hike taxes, wages, and regulation, or the markets rally all the way till the election, increasing the chances of President Trump's re-election, which would revitalize the global system, especially on trade, and would require a sell-off around December. So either way, number one, we're going to have a lot of volatility until we get to November. And number two, based on either outcome, we could see a sell-off thereafter. So no easy thing in getting around this election in November. According to Liz Ann Saunders, one of my concerns is investor complacency, bred from the stock rocket launch off the lows. What have we seen? Time after time, just back in December of this year, we had a 20% decline and the markets went straight back up. There's no shortage of catalysts for a consolidation and or a period of heightened volatility, including a second wave of this virus, second ordering of economic effects of the shutdown, simmering tensions between the United States and China, budding election uncertainty, and of course the civil unrest on the heels of the death of George Floyd. So investors have been pretty comfortable with what's been going on, but will that remain to be the case? And I think Robert Shiller, and again, he's the one that did the PE, this is a very well put synopsis of where we stand today. Longer-term analysis of the coronavirus pandemic emphasize that there is a good chance that it will fade within a year or two, especially if a vaccine or effective treatment appears. I hope that's true. But even if it is, I'm worried that the economy may not return to normal within that time frame. Big events like a pandemic have the potential to leave behind a trail of disruption. They can create social discord, reduce people's willingness to spend and take risks, slow down business momentum, and shake the confidence of investments. That's a very somber way of looking at this. And so no matter how this goes and how the next 6 months unfolds, remember, the fundamentals of investing remain the same. And although it's tempting, especially during times like this of such great uncertainty, to go to cash, that's seldom the right thing to do. Our portfolio manager just completed our second half capital markets outlook, and we will be spending our time implementing our strategy accordingly. And remember, given everything that we've talked about this afternoon, it is highly likely that volatility is going to persist. And unfortunately, I would say it could get worse before it gets better. We're going to continue to do our weekly updates, something new that we've implemented during this, and we're going to continue to do that. And I'm going to remind you, my staff has done an incredible job. Our office has remained open, we're here, and it is more important than ever before that you're making the time for your regular reviews. We need to know if something has changed. We need to know if your life dictates a little bit of changes in your portfolio. So make the time, come in for your reviews. And although we're not doing personal meetings yet, and I'm not sure when we'll be able to return to do that, our technology is allowing to be able to do face-to-face reviews via the computer, or we can talk by phone. But please make the time to come in so that we can make sure that you're up to date and understanding everything that we're doing in your portfolio and managing your situation properly. And most importantly, stay safe and be well. Thank you so much for tuning in this afternoon.